welcome everybody. My name's Matt from Fiducia Wealth Management. We're very fortunate today to be joined by Michael Hughes. For those that aren't aware of Michael, Michael is our economic advisor and a consultant to our investment committee. The benefit he brings to us is his outstanding investment experience, which spans over 30 years. Previously, Michael was the Chief Investment Officer and Director of Barings Asset Management. He's also spent time as a Managing Director at Barclays Capital. And in addition to that, was the Chairman of Barclays Capital Pension Fund. Among other things, Michael has been a council member of the University of Essex and a keen contributor to numerous newspapers and TV programmes. In addition to helping companies like ourselves, Michael advises charities, pension funds and family trusts. With no further ado, what I would like to do is just crack straight onto it. If at any point in this Q&A you feel you need to ask a question, please feel free to put it into the chat, or as Michael's previously said to myself before we got going, if you feel the need to jump in and ask Michael a question directly, Michael's happy for you to do that. If you can wait and towards the end to do a Q&A, that'd be great. But with no further ado, let's crack on and let me introduce Michael to you. Michael, over to you.
Good morning. Thank you, Matt, and welcome to everybody. Thank you for joining us. What I intend doing this morning is giving you a sense of where we are coming from in terms of our investment thinking, and that obviously affects the way we are designing portfolios. So there are several things I'd just like to cover. The first is looking at the consequences of having a very long period of zero interest rates, because we went for about 13 years where interest rates were virtually zero. And that has thrown out loads of distortions, which we're still beginning to see. The obvious one going back to last September was the impact that had on the UK pension market when short rates started to rise aggressively, and so did long-term interest rates. And you had something called the LDI crisis, which seemingly came out of the blue, but was a consequence of a very sudden monetary tightening and the reversal of that long period of zero interest rates. Equally, you've seen the regional banks in the States particularly start to find that they now have problems because they have assets and liabilities mismatched. I'm excluding SVB from this because that has a very specific set of issues. But broadly speaking, there are banks, largely smaller banks, that have been caught out by the speed of change. You might also say that the collapse of the cryptocurrencies and those things have benefited from a zero interest rate environment was also part of this particular scene. And I think that in that period, we saw a lot of capital being misallocated. And I suspect it's going to come through in things like space tourism, for example, which may not be quite as feasible now as had been hoped for. Now, there are some good news that comes out of this, is that we've kept a lot of zombie companies going for longer than perhaps we should have done. And now that they're coming to have to address their situation, it's to the benefit of the stronger companies that have come through this pretty well, but haven't had the benefit of adding to market share because of the maintenance of these zombie companies. So there is a silver lining in this, but I think the first point I'd make is that these sort of distortions or shocks to the system are probably not over. You can't go through a 13-year period with extreme interest rates as we've seen without there being other consequences. So prepare for other shocks, and by their very nature, you don't always see them coming. You might think you can see them in the buy-to-let market and some of the areas that have been very highly leveraged with lots of debt, but it's not as obvious as that. So expect further shocks down the road, but I think that most of them, I suspect, will be able to be overcome relatively easily. The second point I'd like to make is that the tightening of interest rates that we've seen has coincided with the central banks reducing their balance sheet. For many years, we had something called quantitative easing, which was basically the banks printing money that supported other banks or commercial banks, and more importantly, supported the real economy. That has reversed, and central banks are now reducing their balance sheets, reducing the amount of liquidity they're giving to the real economy. And that combination of aggressive interest rate tightening at the same time that they're reducing their balance sheets seems to me to suggest that monetary policy is actually tightening far quicker than I think they should be tightening. And I can understand the political pressures they're under to make sure that they are seen to have inflation under control. But my fear is that they are underestimating the consequences of doing both those things at the same time. So I don't anticipate much more tightening of policy, and much more importantly, I suspect that monetary policy will begin to ease within this year and certainly into next year. So I think we're very close to, if not already at, the peak of monetary policy tightening. That brings me to the third thing, which relates to inflation. Inflation has come down a bit, but probably not as much as perhaps people had hoped. I'd make the point that if you go back to the early days when inflation took off, a large part of that increase was down to supply shocks. Obviously, the events in Ukraine and the impact that had on the world energy market was a big part of that, but also the degree to which the pandemic closed down major economies, not least China, and hence disturbed the supply chain that affected industries right across the board. So a lot of that inflation was supply driven. Now, most of the indicators I look at suggest that supply shock is over. But if anything, supply is more or less back in harness. There will be one or two exceptions to that, but broadly speaking, it's back in harness. Oil prices are lower than they were a year ago. You've started to see container rates and freight rates fall quite dramatically. You've started to see economies open again. China's the classic example, having had a shutdown over 2 years. You've seen fertilizer prices fall, and the fall in fertilizer prices, the fall in wholesale oil prices haven't yet fully come through to the retail network. In other words, we still have a long way to go before food prices really start to fall. But my suspicion is that inflation will actually fall a lot quicker than perhaps people are currently expecting. Perhaps they're hoping it will, but I suspect that these supply changes actually are going to lead to an inflation surprise over the course of the next year to 18 months. So the government thinks inflation could be more or less near to target by the end of the year. I suspect it will be under target by the time we get into 2024. So against that particular background, it might appear that the inflation problem is going to solve itself. Well, over the short to medium term, that may be true. Over the long term, however, there are two factors that make me feel that we're now into an era where the inflation rate is going to stay higher than it has been in the last 10 years for longer. And those two factors are these. The first is the impact that China and Eastern Europe have had and are no longer having on the global economy. If you went back 10, 15 years, as these two economies opened up to the West, as they started to be a cheap source of supply of goods to the West because their labor costs were much lower, we all benefited from the impact that had on global prices. Well, that increase in the supply of labor, the supply of goods that came from these two significant parts of the world had a very positive impact on inflation. That is now changing. They're no longer able to have low labor costs. As their economies expand, particularly in the case of China, living standards are going up. People are demanding a better return. The same is true in Eastern Europe, which wages are getting much closer to Western standards. And so the era of cheap labor is over. And that obviously means that we're no longer going to have as positive a supply shock. The other factor that is changing and is longer term in nature, and we're seeing it perhaps more so here in the UK at the moment, but it will be more widespread than us, is the impact of an aging population. Demographically, most economies, and the exception here, which is an interesting one, is India, but even China and certainly the Western world is starting to see an aging population with more people retiring. They're not prepared to work to the same degree as they may have done. even if they have part-time working. And that means that there's a degree of supply shortage, particularly of skilled labour, which will mean that the pressure will be on skilled wages for some time to come. So both those factors lead me to feel that over the medium term, over the 5-10 year period, we're probably looking at an inflation rate much higher than the 2% or so that's been the official target for the last 10 years, which has been achieved relatively easily, partly because of the factors I've just been mentioning. The markets at the moment are priced in something like a 3 to 3.5% medium-term inflation rate in the UK, something around 3% in the case of the States. So even they are looking to a medium-term inflation scenario that's higher than the central bank target. So that begs the question about whether central banks need to maintain a brake on the system for longer, even if they may have to take the foot off the brake for reasons I've indicated over the next year. The fourth thing I want to mention, which is affecting our thinking, relates to the UK. Now, the UK stock market, and indeed sterling, are very undervalued. And you would imagine that that's pretty easy to understand. Given the politics of the last year, given the degree of economic stress that the UK has been under, it perhaps isn't so surprising that sentiment is so negative. But over the last few months, there has been quite a turnaround in the UK's financial position, not necessarily their economic one, but their financial one. And I draw three things to your notice. The first is that if you look at our pension funds, they are now in financial surplus. I've been in this game a long time, and I don't remember seeing pension funds with this degree of surplus ever before. And that has largely come around, and very quickly, by the change in market circumstances last autumn. So the consequence of equity prices falling and long-term interest rates rising changed the asset liability mix of pension schemes. So they went from a deficit to a surplus situation. Now that is quite reassuring. I notice the government is trying to get in on the act to encourage pension schemes to club together and fund big infrastructure projects. But that's a political ambition. The economics of the game is that their position has changed, which basically means that companies have the choice now of whether they want to contribute more to their pension fund. Clearly, when there was a deficit, they had to. But now they don't have to. There is money potentially available for them to use to grow the economy or to buy in their shares if they want to. But either way, not necessarily to have to support the pension fund. So that's a big change. And it's happened relatively recently since last autumn. The other thing that's quite noticeable now, and this has been going for quite a while, but gathered a pace again over the last year, is that if you look at the net international assets that the UK owns, they've risen steadily over the last 20 odd years. And they now add up to something which is equivalent to 100% of the size of the economy. Back in 2000, they were just zero. And that's come about by three things, really. The first is that UK companies have been investing more overseas than they have in the UK. Now, we hear a lot about the UK not having a very high investment rate, which is true, but that doesn't apply necessarily for companies as a whole, because they have been investing overseas. You've seen our big investment institutions also invest overseas because they've had a more negative view on the economy. The very fact that we have this stock of overseas assets means that A, we can draw down an income from that, which counters the current account deficit that we have. And also it underpins the UK. Now, the third factor I should have mentioned that created that position was the long-term decline in sterling. So sterling coming down over the last 20 years steadily has increased the value of our overseas assets. So now we have a cushion, if you like, in terms of our international wealth that is quite sizable and actually provides, I think, a cushion to the economy as a whole, but to individual companies particularly. And if I add to that the fact that the dollar has been the preferred currency until at least the autumn of last year, you will see that the combination of a very strong dollar and a perception of a weak UK has led to extreme valuations for sterling and for the UK stock market. I think that pessimism, therefore, is overdone. And I think that the UK is now in a much, or the UK markets are in a much more attractive position than they have been for a while. So it wouldn't surprise me to see sterling rise over the next year or two, particularly against the dollar, but not exclusively. I think actually we're better underpinned than we've been for a while. And another thing which I would add to that, or two other things actually, the first is that the Northern Ireland Protocol actually has changed our relationships with Europe. There seems to be much more of a willingness to engage, and by virtue of that, there is the ability for other regulatory changes to be agreed. So that, I think, is a turning point in terms of the political assessment of the UK, given the negativity that we've clearly had over the previous 2 or 3 years. And although we are starting to announce various trade deals, so we've seen one with the Trading Pact in Asia, we've seen smaller ones with New Zealand and Australia, I suspect we're very close to seeing a major one with India. So in terms of UK's standing in the rest of it, I think that is also changing. And one final thing I would say, and we saw it earlier this week, is that the credit rating agencies that had put sterling and had put the UK on negative watch because of the events of last autumn have now changed direction. We're now back into a AA rated, a reasonably high rating, because the credit rating agencies view our situation as having changed. So my fourth point is that actually the UK looks quite undervalued. My final building block relates to market conditions generally at the moment. Because of the cautiousness that we have seen over recent months, large institutions worldwide have built up their cash. Their cash is now much higher than it is on average over the long term. And I suspect that as conditions improve, or perhaps as the pessimism starts to fade, I see that cash returning to markets. We haven't seen much M&A activity. We haven't seen many new companies coming to the market recently because of that more pessimistic perspective. But I suspect that might begin to change, and hence the cash is available for them to start using. The other thing I'd say, which is largely anecdotal, but we're in the third year of the presidential term, and history is a support for markets in the third year, because that's always the best year of the 4-year cycle for stock markets. And the reason for that is relatively simple. Because there's an election coming in 2024, you start to see the bribes, if you like, or the support to the economy starting to come through. We've seen this with the Biden administration and the major infrastructure spending program that they've introduced. And I suspect that there will be other things coming the nearer to the election we get. So by and large, I think the markets normally behave in a much more optimistic fashion in this stage of the cycle. So how do I put all that together? Well, in recent months, going back to the autumn of last year, we started to shift our portfolios away from what we call real assets, which are the inflation protective assets, things like commercial property, infrastructure, gold, and private equity, back into financial assets, things like equities and bonds. And we went back into bonds for the first time in many years, frankly. So that shift reflected the idea that inflation will start to come down this year, that it's, although there may be a permanently higher inflation rate, it won't be anything like the 5 to 10% that it's obviously been to. And so we've started to shift the balance risks. We are not yet at a stage where we are putting more risk into the portfolio. So we're now neutral on bonds and equities. We've added hedge funds as an insurance policy, and we have also added a bit to commodities, but we've reduced our infrastructure and our private equity holdings, because they are the ones that had actually done very well during the last 18 months or so when the rest of the markets were suffering, and we've adjusted that balance. So we'll be looking to add even more risk if the scenario I've suggested starts to unfold. But many of you have asked questions about how defensive our portfolios are. Well, for the prudential portfolios, for the balanced portfolios, we have quite a high defensive position. By that I mean we have quite high cash ratios for both the prudential and the balanced funds. We have bonds, we have hedge funds, we have index-linked bonds, and we have some commodities, not least gold. So our defensive positions for the prudential portfolio are about 50% of the total portfolio. They're about 40% for balance. So there's quite a high proportion of defensive positions already built in to those two portfolios. For the more aggressive risk-taking portfolios, the growth and the adventurous, obviously we have more risk in those and less defensive positioning. But there's still a bit of defensive positioning there in the context of hedge funds and commodities, but less so in terms of bonds and cash. So I hope that gives you a flavour of where we are coming from, what we have done, and what we're hoping to do. And if you have any questions that arise because of this, I'd be very happy to try and answer them now. So Matt, if I can hand over to you and see if there are any coming through your
end. Great, Michael. Thanks for that. It was really insightful, and I'm sure everyone will agree. It's great to hear your thoughts on the economy, our actual portfolios as well, which is important for our clients themselves. I haven't had any questions come through directly. I have got a couple of other questions that I do want to ask. Just going back on your last couple of comments, you mentioned about having surplus in the portfolios, as in you're happy to take on more risk even when need be, and the parameters set out for that. You mentioned about UK being undervalued. Would that be an area that you'd be looking to increase the risk by taking in positions in the UK?
Well, when we did the switch away from real assets to financial assets, we did increase our exposure to the UK because that had been quite low previously. So we have made the first adjustment there. But if we see the conditions that encourage us to take even more risk, then actually the UK would be one of the areas that we'd be looking to add more to. Also, actually, some of the emerging market areas, which are also quite cheap. I mentioned India. I suspect we might be looking at India more closely during the course of this year than we have done for some time. But to date, we have a pan-Asian exposure, which obviously reflects China more than anything else. But we would be looking to add to emerging generally as part of that upgrading. But that isn't happening yet.
Okay, great, thank you. Someone's asked a question with regards to inflation and where you think it's likely to settle in the UK.
Well, I see it coming down below the government's 2% target by this time next year. I don't see it staying down there. That's the problem, really, or indeed elsewhere, I have to say. Because
does it need to stay low?
Well, I suspect that over the medium term, and remember we're going into an election, so I can't see policy tightening aggressively. In fact, if anything, I think we probably find that the budget of March next year, much as we're seeing in the States this year, is going to be supportive, partly as a means of showing that they've got the thing under control and there's an election coming. So that's me being cynical perhaps, but that's the way cycles tend to go. So I suspect that that may add a little bit to the inflation story. But I suspect for the two reasons I mentioned, the two strategic reasons, I think we'll see inflation settle here over the medium term, somewhere between 3 and 4%. There will be times in the cycle where it'll go above that. Excuse me. And there'll be times in the cycle where it'll be below. That does beg the question about whether the inflation target should be adjusted or indeed whether it should be diluted. And the Bank of England remit should be as much about sustaining economic growth as it is about controlling inflation. And that's a situation we have with the US central bank, that they have a double remit to ensure that they have more or less full employment and inflation under control. So it wouldn't surprise me if we had that sort of debate starting in the UK.
Yeah, great. Going back to, you mentioned a very valid point and something everyone should take on board about shocks and being prepared for future shocks going forward. How would you propose to prepare for that? Obviously, we've all seen oil prices, energy prices rising. We've now started to see some sort of stabilization, specifically in the oil price, in and around that $70 to $80 per barrel. How do you propose, in terms of someone's portfolio, how would you propose that they better prepare for these shocks going forward?
Well, to some degree, we have done that by having quite a high proportion of defensive assets. So that's obviously particularly relevant for the low risk models. So Prudential and Balance are the two good examples of that. But even for the higher risk models, we have some hedge funds, we have gold, we have some commodities. So we've got some defensive positions there. But we also have a relatively low sector exposure to the financial sector. Because if you have shocks in the system, it tends to be, even if it's not directly impacting on banks, it can indirectly impact on them. So they're normally an area that does tend to suffer somewhat. Now, in fairness, I have to say that the banks are much better capitalized now than they have been for years. If you look at the what's called the Tier 1 ratio for UK banks, that's now 16% of their total balance sheet. Well, back in just before the gold crisis in 2007, that was 4%. So their balance sheets are much better structured now than they were then, and arguably they can therefore withstand things better than they did then. But equally, if there are non-performing loans, if there are shocks to the system, then that can impact on their profitability. So the financial sector is one that I think, in terms of our sector exposure, we have a relatively low exposure to.
Good. I mean, it's all well and good them having good Tier 1 capital ratios and being better positioned to deal with the shocks. But as we saw recently with Silicon Valley Bank and how they were managing their funds internally, mismanagement and so forth could be argued against that, I guess.
Well, I think there were very specific factors to them. They didn't have a risk officer to start with, which for a major bank is a bit of a problem, I think. But for the sort of risks they were taking, not to have anybody supervising risk is, and I'm amazed the regulators that allow them to keep doing that for as long as they appear to have done it.
Yeah, I think you're not alone thinking like that. How much of an impact do you think obviously the ongoing war in Ukraine, how much of an impact do you think that's still having on markets, if any? And well, I'm not even going to ask a question of how we resolve that. It's not for you and I to discuss. But yeah, in terms of impact on financial markets, is it a global impact? Is it segregated into specific regions?
Well, clearly it's not gone away, although clearly it's not as high a profile in the news programs and newspapers as it clearly was for most of the last year. Until such time as there is a degree of resolution to that, that's holding me back from putting more risk in portfolios, because it's the one part of the jigsaw that isn't falling into place. You know, the inflation story is falling into place. The unemployment and interest rates story are falling into place. The underlying economies, although slowing down, they're not going into the sort of global recession that we had back in 07, 08. So all those things are pieces of the jigsaw that are looking more reassuring. But the Ukraine situation hasn't yet been resolved. And you know, clearly there is a real concern about a new wave this spring. That's been threatened. It hasn't materialized yet, but clearly it's something that can happen. You're also, with the US election coming forth, if Donald Trump were to get in, he's already campaigning and saying that the US isn't going to be as supportive to Ukraine as it clearly has been. So that tends to divide the united front that has been supportive of Ukraine to date. So there are factors that lead you to believe that this situation clearly isn't going to go away, but equally is nowhere near being resolved. And I don't have the magic solution to this, or can see how it will be forthcoming. But as and when you can get some degree of negotiated settlement on this, if that is at all possible, the better. But I'm not hopeful that can happen anytime soon.
No,
That does hold me back from recommending high risk taking.
that's understandable. Just want to go back on to interest rates, and obviously we've become accustomed to low interest rates for a number of years now. Obviously, you'll remember times when interest rates were really high prior to them dropping to all-time lows. In terms of the impact, the interest rate hikes, as we call them now, that are happening, do you expect them to have less of an impact on economies and financial markets going forward as they become more regular? Or I suppose it depends on inflation in terms of how that comes down and how often the central banks move.
Well, companies aren't as geared up as they were some time ago. So although it's a negative to see interest rates rising, it's not as big a negative as it would have been some time back. In terms of individuals, by and large, because unemployment is low and wages are actually gathering some momentum, although that isn't evenly spread, I accept, but either way, there's a good part of the economy where living standards are not falling hugely. They're in a better position to withstand these higher interest rates than would have been the case before. Clearly, there are sections of the population, not least the first-time buyers and the younger end of the market, where trying to get the sufficient deposit and trying to get on the ladder is an issue. And we saw house prices in the UK go to something like 8 to 8.5 times average earnings, which is considerably higher than the long-term average, but it's very close to the sort of peaks we had in previous peaks back in the 90s and the early part of this century. So to see that ratio come down, mostly, I have to say, by wages going up rather than house prices falling, but it will be a combination of the two. That will obviously ease some of those pressures over time, but it's not going to happen speedily. It will happen over the next 2 years, I suspect. But the debt servicing costs, i.e. the proportion of people's income that's being used to service mortgages, is lower than it was before. It's still a squeeze, I'm not dismissing that, but it's less of a squeeze than it was previously, partly because a lot of the mortgages taken out in recent years are actually fixed rate mortgages. They're fixed for 2, maybe 5 years, whereas previously most of the mortgages were variable. So the impact was sudden, and because of the degree to which interest rates went up, that was a huge impact and had the consequence that a large part of earnings were going in servicing the mortgage. That situation isn't as extreme as it was before. So although there is some pressure, clearly there is, it's not on the same scale. So yes, there will be some degree of pain, but it won't be as widespread and it won't be as damaging as we've seen in previous cycles. As I indicated earlier, monetary policy is tightening not just because of interest rates rising, but because of credit conditions also tightening. So actually getting a new loan, getting a new mortgage from a bank or a building society is a bit tougher now, or the conditions are a bit stronger than they were before. So that's a double-edged sword. It's not just about interest rates, it's also about the conditions attached to taking out a new loan.
Yes, fair point, very fair point. I just want to say thank you to Mike, who's just put a message in the chat, which has reminded me. You mentioned India earlier as another area to look at possibly investing into, and emerging markets in general. As Mike says, I think he's agreeing with you, saying it's a sleeping giant. Do you see it having a major impact going forward, especially with the lower age profile?
Yes, it will do. what's been holding, and I've got to declare an interest here. I'm a chairman of a company that specialises in investing in India, so forgive any implicit bias in my views, but the more I see India, the more I visit Indian companies, the more I have to say how impressed I am by them. A lot of the guys coming through now are much younger. They've been educated in the West, be it in America or indeed in the UK. They are extremely astute businessmen. And they are either taking over old family conglomerates, which are huge, or building up new companies, particularly in the IT sectors, but not exclusively. You're seeing it in the fertilizer industries, you're seeing it in some of the building material sectors, for example. So that really is coming through. And India has embraced technology far faster than we've done in the UK. So most people now have a bank account, but they didn't before, because they can now open one using their tablet or telephone. And even they don't even have to be able to write, because they're using either their iris or their fingerprint to gain access. And one of the consequences of that is that state handouts, which previously went to intermediaries, who then took a share of that handout before they handed on the cash to individuals, have been totally squeezed out. So these guys could go to a bank, show their ID, and get the state handouts directly without paying any sort of commission. And all that is a combination of technology being rolled out right across the board. And one of the things I noticed on our last trip, you've had a tendency in India for people to come into the cities to work, make money, and then go back to their rural communities. Because the infrastructure has now been built up, the road systems, the railway systems are being built up, a lot of those rural communities are building their own towns, their own resources, and lifestyles are much more pleasant than living in a polluted city. So a lot of these guys no longer have to commute into the Delhis and the Bangalores of this world to work several months for the year. They can actually do their business from a much more pleasant community out in the middle of India. So those things are long-term, admittedly, but they're changing. And I think India is a sleeping giant. The one thing I would say, and it's come very much to the fore in the experience of recent months, where you've had one company in particular that has been deemed not to have the degree of corporate governance that is required of major global companies nowadays. And that's had a big impact, obviously, on that company, but on companies generally in India. So India's come under a bit of a shadow recently because of this corporate governance issue. Well, most long-term investors in India put a lot of emphasis on corporate governance. They always had to, they always do, and it's even more relevant they do now. And in order to do that, you have to visit the companies. You can't do it by just looking at data and balance sheets. You have to go and see them. So it's really important that the major investors, who, if they're not in India, send their teams to India to visit these companies and to have a regular dialogue with them, so that they're reassured that the governance issues are being adhered to. Now that I think is happening. I think it's a salutary record that has got many companies much more sensitive to it, because they see what happens to their share price if they're not. And I think that will be something that people will begin to feel more comfortable with in the months ahead than they clearly have been in the last 9 months.
Okay, great. Well, I think we're all quite bullish on a trip to India now after that, which sounds good.
Can I interrupt just? I mean, how are you doing that then, Michael, in relation to the funds that that you're picking and investing? How are you assessing how good a job they're doing in that regard?
Well, in the past we have had exposure to India, specific Indian funds. We haven't at the moment, partly because I've indicated it's been under a bit of a shadow, and to some degree it did actually become quite an expensive market when you compared it with China, and those are the two comparisons that I think most people will look at. So most of the exposure we have at the moment is indirect, i.e. it's through global emerging funds that have exposure to various areas, of which India happens to be one, but we haven't yet added to the Indian exposure. When I feel it's right to do so, if by and large I mean that's a combination of the relative valuations of India and China coming right, when perhaps the corporate governance story is starting to be more reassuring, and where the government particularly is taking a much stronger regulatory role than has been the case in the past. Those might well be the triggers for us to be going back into specific Indian funds, but we haven't made that decision yet.
Great, thanks, Michael. I take it that's answered your question, James.
Yeah. I was thinking really in relative to the sort of the funds, the investment fund managers, and assessing, you know, how good a job they do in that regard.
Well, we do review the performance of the individual funds that we buy, partly to see what strategic bias they have, you know, in this particular case, what bias they have to India, but equally, if they have a high bias to tech or to financials, that might affect our decision about whether to have that specific fund or to have one that has a more balanced risk profile. So those are the considerations that come less at the asset allocation level and much more at the fund selection level.
Thank you.
Great. Just moving on to a question with regards to going back to one of your points you made, Michael, about pension funds now basically being in surplus. The question, I think this is your question again, James, with regards to the impact of inflation data, and the question is what should we really expect as a long-term goal for an investment portfolio relative to CPI when planning?
Well, the last 10, 12 years have been exceptional because of a zero interest rate environment. So the combination of that, and obviously inflation being 2% or less for most of that time, has meant that you've been able to see 5, 6, even 7% above CPI as a realizable target. That clearly isn't the condition that we're now in. So I think that depending on the level of risk that you wish to take, I think somewhere between 2 and 5% above CPI is a more realistic target. So for low risk investors, 2% over CPI, which probably looked at something like a nominal return of 5 to 6% a year. For a higher risk investor, you're looking at something like 8 or 9% a year, but not double digit.
Interesting.
And your 8 or 9%, that's overall. So it's certainly, yes, yeah. I mean, I think that's sort of in line with where we feel that we ought to be looking now, because previously having had a target of CPI plus 4, it's now looking a little bit
challenging is the word, I think.
Yes, yeah.
Okay, so that just brings me back to I've got 2 questions left, Michael, but I'm probably going to skip one if I'm honest, because I don't want to jog backwards. I'm not very good at that. But what we will say is I want to look more further forwards and look at global trends, and where you see those trends forming to help shape the future economy, and especially I'm looking longer term. I'm not looking over the next couple of years. It's over the next 10 years or so, where you think those trends are going to form.
Well, we mentioned 2 in the context of demographics and the change in the relative contributions from Eastern Europe and China. Clearly, at an industry level, the tech revolution isn't over. You know, I would divide any innovation cycle into 2 sections. The first is you have the product innovation, and then you have the process innovation. So things like the mobile telephone coming in the 80s was a product innovation. It was a brand new product. And from that, we've obviously seen it be used for mass communications, and it's not so much a telephone as a whole mobile computer. Equally, the internet came through for general usage in the 90s, even though it was actually invented much before that. And now you're seeing it for everyday activity. So to some degree, those product innovations have led to process innovation. So a lot of existing companies, banks are a good example, have moved on to internet banking and away from branch banking because there is the infrastructure there to allow them to do that. And we're getting more used to buying things on the internet. So this is affecting clearly us in our everyday lives, but actually existing companies, not necessarily tech companies. And we're about to see the next step forward, I suspect, in terms of the use of AI, artificial intelligence, and also quantum physics. And don't ask me to explain those to any depth, but they clearly do look as if they are taking the whole use of computers and the internet to one level further on. Now that is process innovation. It's creating things that we're probably only able to dream about at the moment, but it may well have quite serious implications for the health sector. So it allows medicines and indeed health remedies to be much more personalized than they have been. Because if you're able to analyze masses of data very easily, that's much better than doing a sample of 100 or 1,000 patients and just seeing what may come out. And that buys time in terms of changing the way you design vaccines or the way you design medicines. If that sample can be several thousand, if not million, because of the availability of data to you, then at the very least, you get a much quicker response to any investigations that you're doing, and hence the degree to which you're able to manufacture new vaccines or new medicines is that much greater. So I think in the healthcare sectors, we are going to see a lot more process innovation. In the context of tech, ironically, I think we're now seeing the next phase of process innovation in terms of AI and things that come from that. So the whole string of things that will come out of all that we can only guess about at the moment. But if you look at the electric car revolution, it seems to me that the growth of electric cars has gone faster than actually the technology, because we're not yet at the stage, although it's coming, where the battery storage capacity, let alone the mobility and access to that, is anywhere near where it needs to be to make that revolution as swift as certainly governments would like, but even as individuals might like. Where I live here, we hardly have filling stations, let alone charging stations, so it's going to take quite a while to change that. But the way that battery technology can develop can actually revolutionize that. But as I say, the idea has perhaps progressed faster than the infrastructure and some of the battery technology would allow.
Yeah, that makes sense. I mean, it's the influx of electric cars or hybrid cars on the roads now, certainly over the past 12 months, has just increased dramatically. I see a lot around my way. So much so that my wife's actually looking at one right now for us. No, interesting indeed. Well, I have to say, I'm all out of questions myself. If anybody else has questions, feel free to jump in or ask via the chat. It's completely up to yourselves. Whilst you're having to think about that, just so you are all aware, this is being recorded and we will be sending it out to yourselves. If there is anybody that you think is of interest to be able to see this, please do let me know who that is, and I'll forward it on. Feel free to forward it on yourselves. What I will say is, obviously, we're having a discussion with Michael. None of this should be deemed as investment advice or financial advice towards yourself. We are just having a conversation. In order to make sure you're receiving the right financial advice, you need to look at your own finances in a bespoke manner, as opposed to in a generalized format as we are right now. But just having a quick click through, there's nothing else in the chat, Michael. I think we've seemed to have covered everything. You can grab yourself a glass of water. I'd like to thank you for your time. I'd like to thank everybody else here for turning up and asking some very good questions. Michael, if you've got anything you want to round up on, feel free to.
No, thank you. Thank you for your time. If other questions arise or come to you subsequently, let Matt know and he'll pass them on to me, and I'm very happy to email a response.
Great. All right, well, let's wrap it up there, everybody. Thanks again, Michael. Excellent as always, and look forward to doing this again in the future. Have a very pleasant Thursday to all. Enjoy the bank holiday weekend.
Thank you.
Thanks very much.
Thanks. Bye.
Bye-bye.